Good afternoon, everyone. Namaskar, Sat Sri Akal. I welcome you all for our income tax session for today. I am C. Ankit Sharma, your income tax faculty for this session. So this is my last session, which belongs to the chapter number 2, that is residential status and scope of total income. In the previous two sessions of this chapter, we have discussed about how to determine the residential status of a person, whether you are an individual, HUF, company, partnership firm, etc. And we have seen that there are three broad categories in which this status is going to be classified. Either it would be a resident or ordinary resident, or it would be a resident and not ordinary resident, or there would be a non-resident. There were certain provision according to which we need to find out the residential status of persons accordingly. Like for partnership firm, company and HUF, to find out whether they are resident or non-resident, the concept is control and management. That according to business meeting, but in case of company, that control and management has been defined in case of other than Indian company, and that is place of effective management. The detail of that is going to be discussed in final level. Then in case of individual, there are certain days concept according to which we will find out the residential status of an individual. And there were some basic conditions for becoming a resident. There are some special cases. In case number B, we have discussed, there were three special conditions. Then we have deemed resident concept. And after finding out being a normal resident or deemed resident, there are again sub-classification for resident and ordinary resident and resident but not ordinary resident. For becoming a resident and not ordinary resident, there are certain other conditions also. Regarding 730 days, 9-year non-resident out of 10 preceding previous year, and so on. On the basis of that, we can find out the residential status of a person. Then we have a special case for crew member of a ship, in which we have seen that the time duration will be counted as outside India from the date of joining in and the certificate signing off. So those were the provision what we already discussed to find out the residential status of a person. In the last session, we also discussed what is the impact of being a resident or non-resident or not ordinary or ordinary. Because there are certain kinds of income which is going to be taxable in case of ordinary, not ordinary and non-resident. And we have also seen that all kinds of income, if it is belongs to our previous year, is going to be taxable in case of ordinary resident, irrespective of arise, received and confirmed. That is should be related to current year. In case of resident and not ordinary resident, there were income arises or received or control from India is going to be taxable. And in case of non-resident, only income arise or received in India is going to be taxable. So till that, we have discussed the provision. Today, we will complete that part. We will also complete the meaning of income arises, deemed to be arises, received or deemed to be received in India. And then we will complete the illustrations, the test your knowledge questions, our MCQs, and institute prescribed MCQs also. So we are going to have a lot of practical question today to solve. So that will going to strong the base, the foundation of the chapter. Because I've always said that when there is a numerical topic, a practical topic, we will always going to solve questions to become an expert in that. But as usual, before starting the class, the thought for the day is very interesting. So you can see today's thought for the day is, the bad news is that time flies. We cannot control the time. It flies. This is the bad news. But the good news is You are the pilot. So you will decide that in which way you have to use your time for the betterment of your future. So the bad news, you cannot control it, but the good news, only you can control in which way you want to use that time which you have. So time is a very constant thing, and it's technically the only thing I believe which is equal for everyone. So even I have 24 hours in a day, and even Mr. Ambani has 24 hours in a day, and even you have 24 hours in a day. So it depends that how we are going to utilize these hours to decide our future. So there's a good news and bad news both. It depends how you are going to utilize your time. Okay. So now we will start the provision what we were discussing in the last class. So good afternoon, Ms. Maroju, Tejaswin, Nitish Sharma, Nikethan, etc. Okay. So now we are moving on to the provision what we have discussed. We have discussed this table completely. There's a clarification regarding liability to income tax in India of a non-resident seafarer receiving remuneration in NRE account. So there is an account that's called NRE account. That means non-resident external account maintained within Indian banks. There is a specific benefit has been provided to a non-resident sailors. The seafarer means the sailor. So if income by way of salary, you can see that income by way of salary by non-resident seafarers, that means sailors, for services rendered outside India on a foreign going ship with Indian flag or foreign flag and received into NRE bank account. Now you can see he is a non-resident providing service outside India, but amount is receiving in the NRE account in India. So that will not be taxable in the hands of that non-resident. That is a special exemption is provided for this. Generally, we decided that the provision says whether you are a non-resident, but if income received in India, that is going to be taxable for all. But this is an exception because the exemption has been provided to the seafarers. Okay. Now, what is the meaning of income deemed to accrue or arise in India under section 9(1)? So we have discussed in the last session that whether you have an income arise in India or deemed to arise in India, treatment is going to be same. It is going to be taxable for all category of person. But what exactly the meaning of deemed to arise in India? Deemed to arise in India means indirect connection with India. So income is not directly connected to India, but indirectly it is connected to India. So the indirect source of earning that income is belongs to India. So we have multiple cases to understand in different situations what income should be treated as income accruing or arising outside India directly or indirectly or through or from. So we will discuss all these package what you are seeing over here, all the definition, all the squares, all the rectangulars, whatever you are seeing over here. We will discuss each and every later in detail in this chapter one by one. So here we are, income deemed to accrue or arise in India. So that means indirectly connected to India. So certain types of incomes are deemed to accrue or arise in India, even though they are may actually accrue or arise outside India. So you might feel that technically income is earning from outside India, but there is some connection. So due to that connection, that certain part or full income will be treated as deemed to arise in India and going to be taxable for all kind of residents or non-resident. So any income accrue or arising to an assessee in any place outside India. So technically is income arising outside India. But if that is directly or indirectly through or from any business connection in India. So technically income is arising outside India, but if it is due to any connection from India, so that will be treated as income arises or deemed to arises in India. So that will fall in the category of deemed to arise. Or if income has been arise from any property in India. So if income has been arise outside India, but there is some business connection in India, that will be called deemed to arise. We have the certain example. Do not worry, we will discuss all the example regarding each and every point. Business connection example, property in India example, if income from any asset or source of income, if there is a transfer of a capital asset which is situated in India, would be deemed to accrue or arise in India. So the rest of the chapter is going to discuss about only these provisions. So the detail of the remaining 4-5 pages is going to discuss about these concepts and income deemed to received in India. So now point number 2, in case of non-resident, the following shall not, however, be treated as business connection in India. So the first point says, in the case of business, in respect of which, why in case of non-resident? Because if you are a resident and ordinary resident, then it does not matter where income has been arised because it's going to be taxable. But in case of non-resident, it has been explained in detail in the case of business in respect of which all the operations are not carried out in India. Let me tell you with the help of an example, simple. Suppose there is a company XYZ Limited and it manufactures cars. All the activities relating to manufacturing has been carried out outside India. All the activities regarding manufacturing of car has been carried out outside India, suppose in USA. And all the cars also going to be sold in USA. So there is no car is going to be sale in India. So all the activities are outside India and even all the revenue generation will be from outside India. But this company used India for the purpose of manufacturing of tires only. So the car, all parts, etc. is going to be manufactured outside India, but the tires are manufacturing in India in a unit of XYZ Limited. And after manufacturing, they export these tires to get assembled in those cars. So now you can see the whole operation of the business even does not carried out in India. Not even any income arise outside of India because they are not selling these tires into India. They manufacture those tires and export those tires to its holding company for being assembled. So there is no sale purchase technically involved regarding the tires. So whatever sale generation or whatever income generated by this non-resident company from selling of these cars outside India, suppose they generate the income of 200 crores. But there are some element of these tire also, which has been received as a revenue, which is included in the, of course, selling price of the car. So in that case, the whole income will not be treated as deemed to arise in India. You cannot say that if there are no tires, so car cannot run. So we need to tax the whole 200 crore rupees also as deemed to arise in India, but that is not deemed to arise in India. But in that case, income tax says a certain portion, a certain proportion of that income will be considered as deemed to arise in India. So that might be the selling price of that tire which has been included in the value of the car. So it might be 5%, 2%, whatever amount it is, in a proportionate rate that would be chargeable as income deemed to arise in India. So the provision says if a non-resident earn income from outside India from its business activity, but some business activity is also carried on in India. In that case, the income arises outside India cannot be 100% or fully be treated as income arises or deemed to arise in India, but a certain portion which is proportionate to that amount or to that manufacturing which has been work has been undertaken in India could be treated as income deemed to arise in India. Suppose what? Out of this 100% production of tires, 90% is going outside India, but 10% tires they are selling in India. So in that case, what will happen? Of course, if they are selling in India, then income is directly generating from India. So that will be arise in India, and that 10% part is going to be taxable fully. So that is directly, so that is arise or earn or accrue. And this would be called whatever proportion. Suppose we decided that 5% of this profit would belong to the tire manufacturing operation. So that 5% would be called deemed to arise in India, because that is indirectly connected to that business activity. So the 10% part which is sold out in India, that is directly arise, so it is arise. And this 5% of the tire cost out of those revenue or income which we generated after selling of those car in USA, that will be called indirect connection. So it would be called deemed to arise in India. I hope it's clear. Okay, Maruju is asking, sir, if the employee transfer his or salary to his NRE account by himself, it will be exempted from tax or will come under remittance. So in that case, if employee received that amount of salary somewhere and then transfer in NRE account, that it would be a remittance. Then it's not going to be taxable for anyone. But if directly received in NRE account, then it is exempted only for the sailors, not for other activities. Okay. Okay, Bhavan is asking, sir, how to determine what proportion deemed to be rise in India? That's depend upon the case of the fact of the cases. So that will be different in case to case basis. So we cannot decide it. It will be decided by the government according to the situations. Okay. So now you can see the question, the provisions directly says, in the case of a business of which all the operations are not carried out in India. So that means there are some operations has been carried out in India. The income of the business deemed to accrue or rise in India shall be only that part of income which is reasonably attributable. So that means proportionately upon such a specific condition to the operations carried out in India. Therefore, it follows that such part of income which cannot be reasonably attributable to the operation in India is not deemed to accrue or rise in India. Clear? The second point is purchase of goods in India for export. Let me tell you with the help of an example. Second case says, suppose there is Mr. W who reside in West Indies. He's a businessman. He purchased shoes from India. He purchased shoes from India worth rupees, suppose 50 crores. Clear? And per shoe cost, or suppose 50 crore rupees, and he sold these shoes in USA for rupees, suppose 110 crores, and earned a net profit of 40 crores. So now you can see, if government will say, our department will say, okay, now this is going to be deemed to arise in India. So apply your logic and tell me, not logic technically, apply the provision what we discussed till now, whether this 40 crores should be treated as income deemed to rise from India or not. Is there any indirect connection from earning that income, or is there no indirect connection from earning this income? So the provision says, if you purchase any goods from India, like 50 crore rupees goods he has been purchased, so that 50 crore must have been given in India to any person. Suppose Mr. P is the manufacturer of shoes and Mr. W purchased goods worth rupees 50 crore from Mr. P. So that 50 crore rupees received by Mr. P. So that is going to be direct income of Mr. P. We are not asking in respect from Mr. P, we are asking in respect of, from the point of view of Mr. W, that if any person purchase goods from India and then sell it anywhere outside India, then the profit arise to him would be a case of income deemed to arise from India or not. So the concept says no. If any person purchase goods, in the above case, that was the manufacturing. Some activities has been carried out in India. In this case, he is already paying 50 crore rupees to Indian person. So that would be chargeable to tax in the hands of P. But there is no connection in case of trading. So if you purchase goods from India and sold it anywhere into the world, then the profit arise from that is not going to be deemed to rise India or earned. So that is not going to be taxable in the hands of Mr. A if he is a non-resident. Clear? Correct. There is no indirect connection. So any earning, any profit from export or trading of goods from outside India, that is not going to be taxable in the hands of the assessee. Purchase of goods in India for export, or we can say from India. It says in case of a non-resident, no income shall be deemed to accrue or rise in India to him through or from operation which are confined to the purchase of goods in India for the purpose of export. Clear? Connection of news and views in India for transmission out of India. So if some news agency is just getting news from India and transmitted outside India, so to whomsoever is the audience which is outside India is going to pay for it. So no income is going from Indian audience. So that is not going to be treated as deemed to rise in India. So in case of a non-resident, being a person engaged in the business of running a news agencies, of publishing newspaper, magazine, journals, no income shall be deemed to accrue or rise in India to him through or from activities which are confined to the collection of news and views. Listen it carefully. If that is going to be transmitted into India, so in that case, we are going to pay for that news, or the sponsors going to pay to that news agency. So that is a direct income. So we are just doing what? We are just collecting the news from India, but not earning any income from the sponsors or any Indian person. And transmission is all outside India. So that would not be considered as income deemed to rise in India. Same in the case of export of goods, there is export of news, etc. But fourth is interesting. Fourth is saying it's not about the shooting of movies, etc. in India. So it says if any person, any non-resident from outside India is come to India for shooting of any movie, etc., and going to release it outside India. So it is just like the same news agency case, but there are some special condition has been inserted. What are those conditions? Let's explain and understand that. So it says shooting of cinematographic films in India to section 911. In the case of a non-resident, no income shall be deemed to accrue or arise in India through or from operation which are confined to the shooting of any film in India. So till now, this provision and news agencies provisions are same. But now here is a special condition. If such non-resident is, so if shooting has been done in India and that movie has been released in India, in that case it's arise in India. But we are saying that if shooting has been done in India but released outside India, so in normal case, that income is not going to be deemed to arise from India, but these conditions should be satisfied. If these condition is not satisfied, then in that case, even if you are shooting in India and releasing outside India, that income could be treated as deemed to arise in India. What are the cases? It says, if such non-resident is an individual. So if the shooting agency or if the producer we are talking about is individual, non-resident individual. So it should be a non-resident and should not be the citizen of India. Now what exactly this provision is trying to say, it says suppose Mr. A is a non-resident, comes to India for shooting of movie. After shooting, if it release outside India, then this is not an income deemed to arise in India. But if Mr. A is a non-resident plus non-citizen of India, this is condition number A. Non-resident and it should be a non-citizen also. If Mr. is a non-resident, or if it becomes a citizen of India. So even if you're a non-resident, but if you are a citizen of India, in that case, this income could also be treated as deemed to arise in India, depending upon how much shooting has been taken place. As in the same case of proportionate cases we have seen in the first example, the car manufacturing tire one. So tire value was taxable. So suppose the movie is for 1.5 hours and shooting is 20% has been in India. So that proportion can be taxable if he is a citizen of India. So that producer, if it is an individual, that should be a non-resident as well as non-citizen of India. In that case, that income is not going to be taxable. If it is a partnership firm, it is not individual. That non-resident, that producer is a partnership firm, then it should be non-resident, and no partner should be a citizen of India or resident also. So all the partners should be non-citizen, all the partners should be non-resident, and firm should also be non-resident. If any of them is going to be a resident or citizen, then that income could be deemed to arise in India. How much it will be, it depends upon the case of the fact of the cases. Clear? Now suppose if it is a company, things are going to be worse now. So if it is a company, then all the shareholder of that company should be non-resident and all of them should be non-citizen India. If any of them become a resident or citizen, so that company might need to pay tax on that shooting in India and arising income outside India. Clear? Deemed P for deemed, W for direct. Okay, good. Let's see if there is any query till now. If you are a resident, you are asking, then any income which is controlled from India, ordinary resident, that's everything is going to be taxable in India. So only for non-resident, these special provision would work. What if the past shareholder does not depend upon the past shareholder? It is regarding the time that which company is going to be shooting. We are talking about the previous year. So if it is a past shareholder which does not non-citizen of India, but it is not in previous year, then this provision would not apply. And let me tell you, these are special cases. Fine. So what proportion is going to be taxable? What is the specific condition? If some shareholder transfer is shared during the time of shooting or purchase, that will decide upon the case-to-case basis. So we do not have any specific rule. It will depend upon the case of the situations. Okay. Activities confined to display of rough diamonds in S and Zs. So in case of a foreign company, so this is for foreign company engaged in the business of mining of diamonds. So if there is a foreign company engaged in the business of mining of diamonds, no income shall be deemed to accrue rise in India to it, through or from the activities which are confining to display of uncut and unsorted diamonds in any special zone notified by the central government in the official gazette. Now, income from property. So if you have a building, if you have a house in India and you reside outside India and you let out that house in India on rent, or if you have any asset and you let out that asset in India on rent, then the income, the rent you have received even outside India will be treated as deemed to arise in India. So any income which arise from any property, whether mobile, immobile, tangible, intangible, would be deemed to accrue rise in India. Fine. The example says higher charges or rent paid outside India for the use of machine or building situated in India, that would be treated as deemed to accrue or rise in India. Deposits with an Indian company for which interest received outside India, also example of deemed to arise outside India. Mr. X, resident in New York, USA, has a house property situated in India, which has been given on rent by him. Then that rent received will be income deemed to arise from India. So rent receivable or received by Mr. X would be taxable in whether such rent is received by him in India or outside, as the house property is situated in India. So if there is any asset which is situated in India, and to let it out that asset, or in any other way, if you are receiving any income or receivable, even the rent does not received by you, but if it has been let out, so that would be treated as a receivable, and that on that receivable basis, that income will be taxable as deemed to arise in India. So how it can be taxable on receivable basis, that you will come to know when we will solve the provisions of income from house property, in which you will understand whether there's an actual rent received or even not received. But if the property has been let out, so that is a accrue income, it is going to be taxable. You will see these kind of example in house property, under salary, etc. It's the same way as in case of business. When we sell our goods on credit, still it will form the income part of our income part of our sale. So the sale will belongs to our credit part, and that is going to be included as the net profit also. So exactly as the same case in case of credit sale, so that is also become the part of our profit. In the same way, if the house property is let out, so technically the person, the tenant will be the debtor, and even if he is not paying rent, so that would be treated as a receivable and going to be taxable for income tax purpose. Income through transfer of a capital asset situated in India. Capital gains arising. Now, what is capital gain? What is capital asset? We have a separate chapter for it, and that is income under the head capital gain. For the time being, I can make you understand that if you have a capital asset, means normal asset like building, land, machine, shares, etc., also included in the definition of capital asset. So if you earn any income via transfer of a capital asset which is situated in India, in that case, that income also going to be treated as deemed to arise from India. So capital gain arising through a transfer of a capital asset situated in India would be deemed to accrue or arise in India, in all cases, irrespective of the fact whether the capital asset is movable, immovable, tangible, intangible. Okay. The place of registration of the document of transfer is in India or outside India, and the place of payment, whether is in India or outside India, does not matter. The asset should be situated in India. So there is a building, and if it is in India, so even if you are getting rent, that is going to be taxable in the above case. And if you sold that property and arise some gain, that means profit on sale of that property, that is also going to be taxable over here as deemed to arise in India. So both cases are going to be taxable as deemed to arise in India. And if something becomes deemed to arise in India, so we all know whether you are a resident, non-resident, does not matter. It's going to be taxable in your hands. Now salary also. The provision says income which falls under the head salaries is deemed to accrue or arise in India. Now, what is the meaning of salary? When any income will fall under the definition of salary, that's a part of salary chapter. If it is earned in India, so if the services has been rendered in India, it would be treated as earned in India. Salary payable for services rendered in India would be treated as earned in India. Further, any income under the head salary payable for the rest period or leave period also. So even if you are working in India and you went outside India for 2 months, so that's called leave period. And your employer said, we will pay you leave period salary also. Even if you are on leave, we will pay you the salary because you are the most important employee of our company. It might be possible. So suppose you are on leave, but if employer ready to pay you leave salary also, so that leave period is also be termed as deemed to arise in India. So if you're actually working in India, that is arise in India. But if you are on leave and if the employer is paying salary for that leave period, so that would be treated as deemed to arise in India, which is preceded and succeeded by services. That means leave period. So any services which is during that leave will be called preceded and succeeded by the service rendered in India and forms part of the service contract of employment shall be regarded as income earned in India. Now, income from salary payable by the government for services rendered outside India. Now, it's a special case, very interesting case. It says if the payer is government, generally the rule is if you are a non-resident and if you are doing service outside India and receive the amount of salary outside India. So that arise and receive both is outside India. So the general rule says if you are arising income outside India and received also outside India and you are a non-resident, so you need not to pay any tax in India. But if the case change, if you are in government employee, so now the payer is Indian government. So provision says it says something like this. Suppose this is Indian government. Mr. A is ambassador. Ambassador we all know, okay? So he's an ambassador. Government appoint him as an ambassador in Japan. So Mr. A went to Japan and providing services on behalf of government in Japan. So he is in Japan from last 5 years. So he will become a non-resident in India. He does not visit India at all. He is providing services in Japan. That means services outside India. That means income technically earned where? Outside India. He is receiving that salary income also outside India. So received outside India and earned outside India. And for a non-resident, if income has been earned and received outside India, that is not going to be taxable in India. It's a general rule. But we are discussing special provision. And it says if you are a government employee and you are a citizen of India and working outside India and getting salary. So even it's outside India receive, outside India earn, that will be treated as income deemed to arise in India. But there is a special provision. When you get the salary, so it is basically generally divided in 3 components. One is part is basic salary. The other parts called allowances. Those are monetary payments. Basic salary also monetary. And others perquisites. What are the exact meaning of allowances, perquisite, basic salary? We will go through when we will discuss chapter salary. And that is called non-monetary. So we will receiving all 3 and all 3 will be treated as deemed to arise in India. But there's a good news. All the allowances received outside India is exempt from tax and all the perquisite received outside India is exempt from tax. So in that case, all 3 will be called deemed to arise in India, but only taxable will be basic salary. So only basic salary component is going to be taxable, but both other allowance and perquisites are exempted. So if the question asks what is the deemed to arise salary, so all 3 will be treated as deemed to arise. But if somebody asks what is going to be taxable, then only basic salary component is going to be taxable in this case. So that is what exactly the provision wants to explain. So income from salary which is payable by government to a citizen of India for services rendered outside India would be deemed to accrue arise in India. The following condition should be satisfied. Salary income payable should be the government. It should be citizen, whether resident or non-resident does not matter. Service has been rendered outside India. However, the exemption is here. However, allowances or perquisite paid allowed outside India by the government to a citizen for service rendered outside India is exempt by virtue of section 10(7). So if all allowances and perk has been exempted, then what is going to be taxable? Only the basic salary component is going to be taxable only. This benefit is available under both the regime, whether you are following default tax regime or you are following optional tax regime. Now, in case of income from other source, which income should be treated as deemed to arise in India and which is not going to be treated as deemed to arise in India? So it says dividend, or we also can also include interest. So dividend or interest paid by an Indian company outside India is deemed to accrue in India and would be taxable in the hands of shareholder or debenture holders. So whether you are receiving dividend or interest from a share of an Indian company, so that is going to be taxable as deemed to arise, whether you have received it outside India or not. Now we have three more income to discuss: royalty income, fees for interest, royalty income, fees and interest income received from following person deemed to arise in India: central state government, person resident or non-resident in India, if money borrowed, royalty services used in India. Let me show you what is exactly the provision want to explain. So provision says, in case of royalty, in case of interest, in case of fees. So if there is a non-resident who is outside India and receiving from India, either he is receiving royalty from India, either he is receiving interest from India, or he is receiving fees from India. So if any of these things has been received by a non-resident outside India, now the question says why somebody should receive the royalty, because he might in India providing some kind of lease or some kind of copyright, patent, etc. So against it, he must be receiving some kind of royalty. Why he is receiving interest from India? Because he might have given some kind of loan, etc. So against it, he is receiving interest in India. Why he is receiving fees? He might be providing some kind of technical services or any kind of services in India. So he might be receiving fees against it. So these are the incomes. And these must be the reason. Now the provision says, so Mr. suppose X is here, he is the payee. Now the payer, we are talking. So if the payer who is paying these income, so if the payer is central government or state government, so if any royalty has been paid by central government or state government, or interest is being paid by central government, state government, or fee. Suppose he provides some copyright to our government and government is going to pay him royalty. Suppose he provides some kind of loan to our government and government is paying interest on it, or in the same way some kind of services and government is paying fees against it. So if the payer is central state government, then all these income will be automatically treated as deemed to arise in India. So he needs to pay tax on it. So he cannot escape from payment tax of tax payment liability. He needs to pay tax on it. But if suppose the payer is other than government, whether the payer is any resident in India or the payer is non-resident. So if the payer is other than government, then concept will be slightly changed. In that case, we have to find out whether that things which has been used in India or used outside India, what we have received from that person. So suppose the other payer is resident or non-resident. So if he is paying royalty, so we need to check whether that lease or copyright has been used in India or not. So now they are trying to explain that in case of other than government, if these things has been used in India. What things? Like lease, loan, or services against which the payment is going to be made as in the name of royalty, interest, or fees. So if that royalty, interest, or fees is paying by other than government, then we have to find out whether these things has been used in India or not. So if these has been used in India, then the royalty, interest, or fees, whatever it is going to be treated as deemed to arise in India and is going to be taxable in the hands of Mr. X. But if these things not used in India, then that royalty or interest or fees would not be treated as deemed to arise. And not deemed to arise means that is not going to be taxable in the hands of Mr. X. For example, Mr. X provide 100 lakh rupees loan to Mr. A in India. Mr. A used this loan for his business, and that business is in India. So if that loan has been used in India and against which interest is paid to Mr. X, then this interest is going to be taxable in the hands of Mr. X because it would be treated as deemed to arise in India. But suppose this loan is not used in India. Mr. A is also having a business in Bangladesh. So suppose this loan has been used in Bangladesh business. Then interest, whatever he is paying to Mr. A, is not going to be treated as deemed to arise in India. You might be thinking if the loan partly used in India and partly in Bangladesh, then of course the interest part which belongs to the amount of loan which has been used in India is going to be treated as deemed to arise, and the part of the loan used in Bangladesh, the interest proportionate to that part would not be treated as deemed to arise in India. So if government is the payer, then there is no need to check whether or where it has been used. But if other than government is the payer in these cases, then we have to check that whether these things has been used in India or not. I hope it is clear. So this is a very interesting diagram, and it will really help you to understand the provision very easily. Okay, so let's move on to the provision. So if the payer is central state government, then there is no issue, always deemed to arise. Other than, then we have to see whether that money borrowed or royalty or service used in India or not. We have an example also. If a non-resident A borrows money from a non-resident B and invests the same in the shares of an Indian company, interest payable by A to B will not be deemed to accrue or arise in India. Okay. Now, income deemed to received in India. So we have discussed what is the meaning of income deemed to arise in India. But now what is the concept of deemed to received in India? Received means what you actually received. That means we can say cash sale. So cash sale is technically received, and credit sale is technically an income which do not received by us yet. So that is technically receivables. So even it will be treated as deemed to be received. So that kind of income which not technically received by you, but they will regard it as deemed to be received, will fall under section 7. Following incomes are deemed to be received in India, even not actually received in India, and taxable in the hands of all category of person. Of course, ORR means ORR, ordinary resident, or we can say it ROR. Right? That is a language, the word what we used. Now, point number 1 is annual accretion in the contribution of RPF. RPF is recognized provident fund, and you will understand this concept that why it will fall under deemed to be received under the chapter salary. There is a detailed provision. What is the meaning of provident fund? What is the meaning of contribution, etc. why this percentage, why that excess will be treated as deemed to be received, everything will be discussed in salary chapter. Now, one more example of this deemed to be received in under section 80 CCD. This is a deduction which fall under 80C to 80U, and I guess there is chapter number 6 or 7, I guess, which will discuss these provisions. So that is going to be discussed later. Then the third is TDS, tax deducted at source. That is also going to be treated as deemed to be received in India. Again, why so? That would be a chapter of TDS in which you will come across the provision and you will understand why these will be treated as deemed to be received. Now we have income treated section 68, 69, 69A, 69B, 69C is as deemed to be received in India. So these are black money cases, and all these black money cases will also be treated as deemed to be received in India. Because practically that black money must have received in some other year. We have discussed this concept in chapter number 1, basic concept, and it says the black money what is earned in some other year, but government find that black money in previous year. So in the year when government will find that money, they will assume that it has deemed to be received in this year. But practically, in actual, it would have been received in earlier year also. So in case of black money, all that black money find out by the government will be treated as deemed to be received in that year in which government will find them out. Okay. So these were the provision. Okay. Now we will move on to the your query session and the test your knowledge, MCQs, illustration one by one. So it will clarify all the provision, all the concept, crystal clear. So let me see if there is any chat box query we have. That company was, we use that money to bought the share. If any interest or dividend on Indian company share, that is deemed to arise. But if we use that money, we do not use it in a business, etc. We just use that amount to purchase the share of an Indian company. And that has not been included as deemed to arise in income. Okay. So let me see the query portal. Yes, everything is important. Sudhir Pandey is asking, sir, are these all important from exam point of view? We are doing CA course. Everything is important. Do not leave anything. Do not go for selective study. Always go for comprehensive studies. Okay. Next is. Okay, Shruti is asking, sir, in 5A, you said income of earlier year or preceding year will not include. Can you explain? Shruti, we have already discussed that thing in detail already in the last session. So if for timing, I can tell you that if any income which belongs to the earlier year, which is not our previous year income, so we are talking about the black money cases on which tax has not been paid. So we will not consider that income for the calculation of previous year concept. So that is going to be taxable with different provision, different penalty, etc. Share is a capital asset or not? Yes, share is a capital asset, Sharmistha Mehti, and that is going to be discussed in the chapter of capital gain. So now we will discuss the illustration and then MCQ, etc. So illustration number 5, page number 2.18 of your study material. These illustration will definitely going to give you a crystal clear view to make you understanding in a better way that how and in which way we going to consider the income arises in India and going to taxable that. So this is illustration number 5 on page number 2.17 technically. From the following particulars of income furnished, Vaishnavi Panchal, sir, my queries are visible. Only this is yes, yes. Of course, everyone's queries are visible if you are sending it on the right query portal. So, question is from the following particulars of income furnished by Mr. Anirudh pertaining to the year ended on 31st March 25. Compute the income for assessment year 25-26 if he is ROR, RNOR, and non-resident. So you can see short-term capital gain on sale of shares of an Indian company. So shares belong to an Indian company received in Germany. So we have discussed that any asset which is situated in India, so any dividend, interest, capital gain, income on any asset which is belongs to India will be treated as deemed to received in India. So this 15,000 is deemed to arise and going to be taxable in all cases, whether you are a resident and ordinary resident. So 15,000 is going to be taxable on all three categories. Next is dividend from a Japanese company received there. So this is not an Indian company dividend, this is from a Japanese company. So if we are a resident and ordinary resident, if we are a NOR, if we are a non-resident, for the purpose of resident, everything is taxable. This 10,000 is going to be taxable. For the purpose of non-resident, not ordinary resident, income arise in India or deemed to arise, income received in India, deemed to received, and income which is controlled from India is going to be taxable. So this 10,000 does not fulfill any of the condition, not going to be taxable for NOR, and non-resident received and arise only. So this is also not going to be taxable for non-resident. Now, rent from property in London, deposit in a bank in London, later on remitted. So I've told you this remittance sentence should be crossed out. You should ignore it completely. So I have to solve this question only with this sentence, that rent from property in London, deposit in a bank in London. And it is rental value as given 75,000. So in the case of resident and ordinary resident, we will consider the 70% of this 75,000, which would be 52,500. Now you might be thinking what we have done. So under income from house property chapter, there is a provision which says any kind of rent from property, building, that 70% is going to be considered for the purpose of income tax. So 30% is a deduction, a standard deduction which has been provided there. So even if you are getting confused, you will read this provision under income from house property. So you consider it 70% over here. Any rent from any property, if you are receiving any building, etc., 70% will be considered after deducting 30% as standard deduction. Okay. What exactly is standard deduction? Why we are deducting it? That we will discuss in income from house property. You understand this? This is going to be taxable for resident and ordinary resident, not for NOR, not for non-resident. Clear? Now, dividend from RPL Limited, an Indian company, taxable for each and everyone because deemed to arise in India. Agriculture income from land in Gujarat, that is agriculture income which is exempt from tax. So here are the provision. We have complete the illustration number 5. You can see the solution. 15,000 taxable for all. Dividend is only for ORR. Then again for ROR only. You can see for rent it is 52,500. Why it is so? Note number 1 below. So in detail it will be income from house property. That has been the note which has been mentioned over here. You need not to bother for it. You just read everything in income from house property chapter. Now, illustration number 6 on page 2.24. Okay. Mr. David, an Indian citizen aged 40 years, a government employee serving in the Ministry of External Affairs left India for the first time 31st March 24. First time he left India on this. Due to his transfer to High Commission of Canada. He did not visit India anytime during the previous year 24-25. So in previous year 24-25, he was in India for 0 days. And he should at least fulfill one condition either for 180, and because he left India permanently for job purpose, only first condition would be applicable, that is for 182 days only. And he was in India for 0 days, so he would be a non-resident. Now, on the basis of being non-resident, you have to tell what income should be taxable in his hand from the following. So technically his status is non-resident. And we have discussed in case of salary income, if received by a non-resident who is a citizen of India outside India, then only salary is going to be taxable. Allowances and perquisites are going to be exempted. So this is going to be taxable. Now these are foreign allowances, not included in first point. So that is going to be exempted. Interest on fixed deposit from bank in India. So he's receiving from Bank of India interest, that is going to be taxable. Income from agricultural in Nepal. So he's a non-resident. This is income arise outside India, received, not going to be taxable. Income from house property in Nepal, again, non-taxable. So only this is taxable and this is taxable, 6 lakh rupees. This is exempted. So this and this is taxable. Here's the solution. You can see that. Now illustration number 7 on page number 2.30. Miss Vivitha paid a sum of $5,000 to Mr. Kulaskera, a management consultant practicing in Colombo, specializing in project finance. The payment was made in Colombo. Mr. Kulasekara is a non-resident. The consultancy is related to a project in India with possible simultaneous collaboration. Is this payment chargeable to tax in India in the hands of Mr. Kulasekara since the service were used in India? So we just discussed this provision regarding the royalty, interest and fees. And the important part where the service has been used. So if the service has been used in India, that is going to be treated as income deemed to arise in India and going to be taxable for Mr. Kulasekara. Clear? Next is illustration number 8. Now there's a huge illustration and I'm going to solve it. I need to open that illustration in some other laptop. Then I will solve it in separately so you will understand what exactly this question is. Just give me a minute. Study material, page number 2.31. Okay. So we have the question. Let me solve it with you. Sainath is asking, will it suffice to clear exam if we stick only to study math and illustration from it? No, you have to complete all the illustration and test your knowledge question from your study material. Also, you should solve RTP, MTP, which will be provided by the institute, and at least 3 or 4 previous attempts question, etc. So if you are going to attempt like 3 and 4 previous attempt questions and the study material all question and the RTP, MTP case scenario which has been provided by the institute, then yes, it is more than sufficient for you. Okay. So I am reading the question and I will solve it over here. If you have taken out the printout of that question, the study material in your hand, so you can also open that question on page number 2.31, illustration number 8. I will write it down in short, what is exactly the income and what is going to be the treatment. So the treatment we need to be done for resident and ordinary resident and not ordinary resident and non-resident. So first it says interest on UK development bonds, UK bonds, not Indian company bond, UK bonds, 50% of the interest received in India. And the total amount has been given in the question is 10,000 rupees. So 10,000 rupees interest on UK bonds, 50% of which has been received in India. For the purpose of ROR, we all know full is going to be taxable. For NOR, it would be 5,000. And for non-resident also, it is 5,000. Simple. Now, point number 2 says income from a business in Chennai, 20,000 rupees. Income from a business in Chennai. So, because the business is in Chennai and it says 50% received in India, how does it matter whether it's received in India or not? Does not matter. If the business in Chennai, so income arises in India, so full income is going to be taxable in all category of person. 20,000, 20,000, 20,000. Remember, for resident and ordinary resident, every income is going to be taxable. Just it should be belongs to the current year income. Clear? For non-resident, only 2 is taxable, received in India and arise in India. For ROR, everything is taxable. And for NOR, received, arise and control is taxable. Clear? So on the basis of this, we can solve each point. Point number 3 says short-term capital gain on sale of shares of an Indian company. Now the shares belongs to an Indian company shares. So again, this is an asset belong to an Indian company. So everything is going to be taxable, received in London. So that is 20,000 taxable in each case. After this example, we will take a short break. Okay. Now point number 4. This is a dividend from British company. Now British company dividend and received in London. And that is 5,000 rupees has been given. So of course, British company dividend received in London only going to be taxable in the hands of ROR, no treatment in other category of person. Next is 5th point. It says long-term capital gain on sale of plant at Germany. 50% of gains are received in India. So plant, that means asset has been sold in Germany. 50% received in India. And total is 40,000. So in case of ROR, full is going to be taxable. For others will be 20,000 because 50% received in India. Next is point number 6. Income earned from a business in Germany, which is controlled in Delhi. So now business in Germany, but control from Delhi. From Delhi. And it says income is 70,000 and 40,000 received in India. 40,000 received in India. So 70,000 will be taxable in ROR. How much is going to be taxable for RNOR? How much is going to be taxable for RNOR? So who is going to tell me? How much is going to be taxable for RNOR? Full 70,000. Well done, everyone. Very nice. Pallavi, very good. Very good, Parna. Very good, Ajay Surya. Well done. Why? Because business is controlled from India. So if business is controlled from India, that means full value is going to be taxable for resident and not ordinary resident. And for non-resident, it would be 40,000 because received in India is only 40,000. Point number 7. Profit from business in Delhi, but managed entirely from London. How does it matter if business in Delhi? That means full is going to be taxable. The amount has been given in question, 15,000 for each and every one case. Clear? Moving on further. Next, point number 8. Income from house property in London deposited in a bank at London brought into India. So property in London, income from that. Now in the question it not been mentioned rent from London. If it is rent, then we would take 70%. If it is income, that means it is already 70% has been given in the question. So in that earlier question, we have done 70% of the rent because it has been written that rent received. But in this question, income is that many. Income means already computed, already 70% has been taken. Deposited in a bank in London and brought to India. Brought in remittance has no meaning. So property in London, amount received over there. So we will consider it only in the hands of ROR, nothing in these two categories. Next, we are reaching now point number 9. There are almost 19 points for the question. Everything has been considered in this question. Interest on debenture in Indian company. Indian company, so that is going to be deemed to receive taxable in each and every one. That means 12,000 for all cases. Then point number 10, it talks about fees for technical services rendered in India but received in London. Now we are talking about fees and rendered in India. So if it has been given in India, used in India, rendered in India, deemed to be received, of course, that is going to be taxable in all cases. 8,000, 8,000, 8,000. Profit from a business in Mumbai. So now business in Mumbai, everything else is irrelevant. Going to be taxable for all cases because it is in Mumbai. 26,000, 26,000, 26,000. Clear till here? Okay. Now point number 12. Oh, that was Mumbai has been done. Okay. Income from property in Nepal received there, computed. So Nepal rental income. Full income has been given, not the rent received. So it will be equivalent to 70%, only going to be taxable in the hands of ROR. 16,000, non-taxable, non-taxable. Because nothing is received in India. Now point number 13. Income from property, past foreign untaxed income. Now this has been the black money provision, the point number 5A. Past foreign untaxed income. So technically that is not applicable case. Non-taxable or taxable is not the correct answer. That is not applicable for our question. Next is income from agricultural land in Nepal. That is not exempted. Received there and brought to India. So received also in Nepal, going to be taxable for this person, non-taxable for these. This is not exempted because it is in Nepal. Agriculture income in India is only exempted, not for Nepal cases. Clear? Okay, next is income from profession in Kenya, which was set up in India, received there, but spent in India. So now the income in the profession in Kenya, set up, that means controlled from India. Received income also there. So that means going to be taxable full over here and full over here because control from India. Nothing is there because nothing is received in India. Point number 16. Gift received on the occasion of his wedding. That is 20,000 rupees. So it has been received in India as a gift. And the question says, how much it is? 20,000 rupees in India. So gifts are exempted technically as per the provision of section 56. Any gift has been received in India is technically exempted. So that is exempted in all category. That is the provision you will discuss under income from other source. Like agriculture income, gift received on marriage is exempted. Next is interest on saving account. That is going to be taxable for all because it's a saving account in India. State Bank of India. 12, 12, and 12. Clear? Next is point number 18. Income from business in Russia controlled in Russia. So of course, only going to be taxable in this because business is in India and received in business is in Russia and received in Russia and controlled from Russia. Next point. It's a huge question. 20 points question. Okay. Dividend from Reliance Petroleum Limited, an Indian company. So that is going to be taxable for all cases. And then agricultural income in Rajasthan. Agricultural income in Rajasthan going to be exempt in all cases. So these were 20 cases from illustration number 8, what we have just discussed. I hope it's clear and it makes the provision also much more clear for you. किरण मिश्रा is saying, sir, केनिया की इनकम को डीम्ड टू राइज इंडिया मानेंगे क्या? कैसे मानेंगे? केनिया इज अनदर कंट्री, केरला नहीं है, केनिया. So that is not deemed to arise. That's why only taxable for only in case of resident and ordinary resident. Let me see if there is any other query. Hardik is saying the royalty fees and interest, if used for business, then taxable in India, otherwise not. So if royalty fees and interest, if used in India, whether for business or other purpose, it is going to be taxable in India. And yes, if it is a business, then we consider it for the purpose of taxability. Correct. Let's see any query on query portal. How to write an exam as given in the study material. In that case, in that table, you will write it down in the examination point wise. Okay. So that was illustration has been completed. We will discuss test your knowledge question and then we will solve our MCQs after a short break. So Mr. Bhargav, can Welcome back, everyone. So I believe you must have your coffee, tea, etc. So let's resume the class. Let me see if there is any query. Okay, no, any query not in chat box. Ms. Tambeshwari is asking, in deemed to arrive tax in more than 50,000 on RNOR means what? I did not understand your question, Tambeshwari. One more doubt in NRE is who is seafarers? That means sailors. I have written over there sailors. So you can find it out on Google also. What is the meaning of seafarers? Those person being a sailor. Okay. Next is, okay, no more queries. So we will have our story at the end of the class today. Let me complete the MCQs and test your knowledge question. Then if we will have time, then our story will be at the end of the class. Okay. So study is the priority. So that was illustration number 8, what we have discussed. Now we are moving on to test your question. Test of your question, illustration question number 1 we have discussed. Now we have test your question number 3. 1 and 2 we have discussed, that belongs to the residential status. Now 3 is for Ramesh and Mr. Suresh. Are brothers and they earned the following incomes during financial year 24-25. Ramesh settled in Canada in the year 1996 and Suresh settled in Delhi. Compute the income for assessment year 25-26, assuming that both have exercised the option of shifting out of the default tax regime. So because Mr. Ramesh settled in Canada, so he would be a non-resident for our example. And Mr. Suresh is settled in Delhi, so it would be a resident and ordinary resident for our question. Now, one by one, we will see what income is going to be taxable in whose hand. So, interest on Canada development bonds, only 50% received in India. So, because Ramesh is a non-resident, so only 50% part is going to be taxable in India. Out of this, so this will be 17,500. And because he is ROR, everything is going to be taxable. So you need not to bother about the ROR person because everything is going to be taxable except the untaxed income. So that is 40,000 tax. Dividend from British company received in London. So automatically nothing is going to be taxable in India in case of Ramesh. And for the purpose of Suresh, everything is going to be taxable in India. Profit from a business in Nagpur. So business in Nagpur in India, so that is going to be taxable for both Ramesh and Suresh. Taxable, and 140 is taxable over here. Short-term capital gain on shares of an Indian company. So because it's an Indian company and also received in India. So that is going to be taxable in both category. Income from business in Chennai, of course, taxable for both. Fees for technical services rendered in India. This is deemed to arise in India for Mr. Ramesh, but received in Canada. So that is a deemed to arise in India, going to be taxable for Mr. Ramesh. Interest on saving bank account deposit in UCO Bank, Delhi, taxable for both. Agricultural income from a land situated in Andhra Pradesh, so that is exempted for both. Rent received, now this is called rent received, not the income from property. Rent received in respect of house property and Bhopal. So for Mr. Ramesh, 70% is deemed to arise in India, and for Mr. Suresh, it's received in India and arise in India directly. Life insurance premium, that is for deduction purpose, so that is not for our use till now. This chapter is going to be discussed later. So that was the solution for test your knowledge, question number 3. Now test your knowledge, question number 4. which says examine the correctness or otherwise the statement income deemed to accrue or arise in India to a non-resident by way of interest, royalty and fees for technical services is to be taxed irrespective of territorial nexus. So yes, the answer is correct. If the technical services has been received in India, then it's going to be taxable irrespective of its territorial nexus. Correct? Theoretical question. Now examine with reason whether the following transaction attract income tax in the hands of recipient or not. First is salary payable by government, central government, to Mr. John, a citizen of India. Remember the provision? 7 lakh for the services rendered outside India, considering that he pay tax as per the provision of section 115 BAC. So point number 5.1 says, yes, the salary is going to be taxable. Only allowances and perquisite, if received outside India, that is not going to be taxable. So it would be taxable as deemed to arise in India. Interest on money borrowed from outside India, 5 lakh by a non-resident for the purpose of business within India. So yes, if it is used in India, if it is for business in India, that is going to be taxable. The third one, post office saving bank interest 19,000 received by a resident assessee Mr. Ram, age 46 years. We need to calculate the taxable income if he's shifting out for default tax regime. So if you receive any interest income from post office, so there is a specific exemption of 3,500 rupees if the interest is from post office under section 10. And there is a deduction of rupees 10,000. This is deduction under section 80 TTA for saving account interest from a post office. So total 13,500 would be exempted. Balance 5,500 would be taxable. So you will read this provision in deduction chapter and this under income exempt topic. So because you did not read these provision over here, so you might be thinking what is happening, but these concepts will be discussed later. Royalty paid by a resident to a non-resident in respect of a business carried on outside India. Now this is non-taxable because the business is carried out outside India. Legal charges of 5 lakh paid in a Delhi to a lawyer of United Kingdom who visited India in respect of a case. Of course, it's taxable because income has been arise in India. So that was your test new knowledge question. Now moving on to our MCQ. So now I will ask and you need to answer. This is a MCQ for residential status purpose and also for incidence of tax topic. So kindly read the question. Question 1 says, an Indian citizen or POIO came to visit India needs to fulfill following condition to be a resident if total income is less than 15 lakh from Indian resources. So what is the correct answer? Is it A? Is it B? Is it C? Or is it none? Take your time and then give me your answer. Okay, Neeru is saying C, Hardik is saying A, Samishra is saying C, Bhaskar is saying C, Vedahi C, Ashutosh is saying A, Shibu, Muskan, okay. Query portal wale bacche काफी slow hai, huh? Okay. Sudhir is saying A, SK Nuruddin is saying A, Bhavna is saying C, Neha PR is saying C, Vaishnavi is saying C. I have told you multiple times, students, kindly read the question carefully first. That is the utmost important thing. You have to read the question first, then you will be able to answer it correctly. So the question is, an Indian citizen POIO came to visit India, need to fulfill following condition to be a resident if total income less than 15 lakh. So if it is less than 15 lakh, that means this condition does not fulfill in point number 3 of point number B, but it is a part of special cases point number 2. And if it is a normal case, when a person comes to visit India, Indian origin or citizen of India comes to visit, in that case, only first condition is applicable. Only first condition is applicable. So the correct answer is A. This is not applicable. If income has been given more than 15 lakh, then there would be like 120 days condition I would have written. In that case, that could be the answer, would be or could be B. But in this case, the correct answer is A. Okay. Chalo, next. An Indian citizen, POIO, came to visit India and having total income exceeding 15 lakh from Indian sources need to fulfill following condition to be a resident. Now, this is a simple question and you can answer what is exactly the case. The correct answer would be question number 2. What is the correct answer? Somebody is saying C. Okay. Malu is saying B. Shanvishta C. Neeru is saying C. Muskan is saying B. Bhumika is saying A. Afsal is saying D. Shruti is also saying D. Anirudh is saying D. Okay. Query portal वाले बच्चे कह रहे हैं C. Bhavna, Astha, Vyakanta, Sabu. Sorry, very complicated name. C. Dilip is saying D. Neha is saying C. So the correct answer is D. Because if you are a person of Indian origin, I do not know why most of you are giving wrong answers. Why? It's a simple question. Apply the provision. So the question is very, very simple and it says that if a citizen person of Indian origin came to India, total income exceeding 15 lakh. That is B point third case. So we have two conditions and you can fulfill any one of them. This. So we can fulfill any one of them. So the correct answer would be D. Anyone from A and B. Both cannot be the correct answer because we need to fulfill only one condition. Okay. Next is XYZ LLP will be in India if control and management of its affairs is wholly situated outside India during the previous year. So what is the correct answer of this question? The correct answer is exactly B. Everyone is giving the correct answer. Very well done. It's B. LLP will be considered as non-resident because the status need to be fine just like partnership firm. So the correct answer is B. Fine. Non-resident. Next is HUF will be called resident on the basis of following. So HUF will be considered resident on the basis of which thing? Place of effective management, depend upon status of Karta, on the basis of control and management, or all of the above. Someone is saying C, someone is saying D, someone is saying B also. Sanit is saying B. Okay. A भी बोल दो कोई बच्चा. A क्यों छोड़ रहे हो? A भी बोलो. B, C, D सारे आंसर थोड़े ना हो सकते. Look, this is the difference. I am teaching everyone in the same manner. Same provision. I'm not teaching anyone personally. We are on a portal. I am teaching exactly same to everyone. But still there are different answers. Somebody is saying A, B, C or D. Why it is happening? Because I am teaching the same thing, but someone of you is giving the correct answer, someone is giving me wrong answer, because those who are carefully actually participating in these classes, those are actually going to revise whatever we are teaching you. Those are again after class. Try to solve these questions. Revise twice. Theories applying. Those are able to give the correct answer. Those are just joining it, just watching the classes, not sincerely preparing for the C examination. Those are giving the wrong answer. In the same way, we do not get the same marks in the examination also, even if we are getting classes from the same faculty. We are all going to solve the same question paper. It depends how you read the question, how much time you give to your studies, how sincere you are for your examination, for your career, etc. So the correct answer is question number 4 is C, on the basis of control and management, because upon Karta status, we will find out whether it's a resident or ordinary resident or resident and not ordinary resident. But on the basis of residential status will be decided on the basis of only control and management. If Karta fulfill both additional conditions, that is more than or equal to 730 days in 7 PPY, and more than equal to 2 years, years की spelling गलत है, ठीक कर लेंगे, 2 years, resident out of 10 preceding previous year, but control and management of HUF is situated partly outside India and partly in India, then HUF would be regarded as what? Question number 5. Correct answer is, so Manvi is saying C, somebody is saying A. So there cannot be two correct answers. So somebody is not studying properly and somebody is not somebody is studying properly. That's why the answers are different. So the correct answer is question number 5. Correct answer is A. Yes, Pallavi is saying correct. A. Pooja is saying A. Preeti Kumari is saying A. Very well done. Asta was saying B. No, not well done. So the correct answer is A. Because if these both conditions fulfilled by Karta, then HUF will be regarded as resident and not ordinary resident. If both condition does not fulfill, then HUF would be a resident and not ordinary resident. Very good. Good. Next. An Indian company will be treated as resident for the year if. What is the correct answer? Very simple question. An Indian company would be regarded resident. Okay, Pranav is saying B. इसका भी आंसर तुम लोग गलत गलत दे रहे हो, कैसे होगा भाई? Okay, it's an Indian company, and Indian companies will always. Asta is saying A. Why? What are you doing? So Indian, somebody is saying B. Sondharya is saying B. Why it's B? It's not a foreign company. It's not a HUF. It's not a partnership firm. Okay, Sainath is saying A. What are you doing, Sainath? The correct answer would be C. Indian companies, I have told you and I have shown you in the diagram also, always resident. Always resident. So if it's always resident, then the correct answer would be C. Chalo. Next. Following are the particulars of income of Kishore. Income from agricultural in Indonesia. Being invested there only, that is 12350. Income from business in Bangladesh, controlled from India, 10150. So if Mr. Kishore is resident and not ordinary resident, what should be the correct answer? What should be the total income in his hand? Hardik is saying B. Trisha is saying C. Aisha Khan is saying B. Because he's a resident and ordinary resident student. So if you are a resident and ordinary resident, so only 3 incomes can be taxable in your hand. If it is arise in India or deemed to arise, if it is received in India or deemed to received, or if the business is controlled or set up from India. Now, if we'll see income from agriculture in Indonesia being invested there only, so there is no arise, no received, not control, this cannot be taxable for that person. Income from business in Bangladesh controlled from India. So it is controlled from India. So this is going to be taxable. So the correct answer would be point number B. Next. Ram earns the following incomes during the previous year. Please take your time and give me the right answer. Question number 8. What should be the correct answer? Okay, somebody is saying D. Question number, almost everyone is saying D. Let's see how it is or what is the correct answer. So interest on US bonds. So he is a resident and not ordinary resident, correct? So interest on USA bond is 50% remitted into India, 4 lakhs. So remittance word is irrelevant, and interest on US bond. So it would not be taxable for a resident and not ordinary resident, correct? Profit on sale of share of an Indian company, because it's an Indian company share, so this is going to be taxable. This one is non-taxable, and this is going to be taxable. Second point. 40,000 is passed untaxed income. So that is irrelevant for our calculation. So the correct answer would be 3 lakh rupees. Next is, which is not deemed to arise in India. Out of these 5 income, which is not deemed to arise in India. Okay, Ashutosh is saying 9. Virendra Sharma is saying 9 is for E. Kiran Mishra is saying E. Anirudh is saying D. Ajay Surya is saying E. Mahima E. Bhavna is saying E. Hardik is saying E. Correct. The correct answer is, of course, E. Because we have seen in the provisions of income arises or deemed to arise in India, interest paid by government will always be arise and deemed to arise in India. Interest paid by resident of India but loan is used in India, of course, arise and deemed to arise in India. Payment by non-resident outside India but used in India, of course, it's a part of arise and deemed to arise in India. Dividend paid by domestic company to outside India, that is also a part of income arises to India. There should be payment by non-resident of royalty used in India, and the correct answer would be E none. So all these 4 is an example of income arises and deemed to arise in India. Now this is different kind of question. What I'm going to ask you one by one. It is true and false and fill in the blanks. So देखते हैं किस किस को क्या पता है. So the day of departure and arrival into India will be, as you might say, outside India. Is it true or false? So we have 4 separate answers. Okay, I'm going to say false. Okay. Hardik is saying false. Somebody was saying true. Okay. Let me see. Dilip is saying false. True. Bhumika is saying true. Very good, Bhumika. So the correct answer is, of course, false, because I have written over here I've changed the language and I said stay outside India. It is assumed as stay in India, not outside India. So if it has been written over in India, then it would be a case which should be true. But because I have changed this word from in to outside India, so that would be a false. Because the day of departure and arrival will assume as stay in India, not as stay at outside India. And we cannot say that in case of crew member, this application. In crew member, there is not the language of arrival and departure that I just told you to make you understand. But the exact word is signing off and joining. Certificate of joining need to be the day of entrance into certificate of joining and the day signing off. Those days should be there for crew members, not the day of departure and arrival. Okay. Now point number B. Salary payable for the leave period, which is both dash and dash by service in India. So I have a very little hope that you would be able to fill these points because we just discussed these provision today. So Kasak is saying taxable. I need to fill these two blanks are there. So what words need to be put over there? Okay, Pallavi is saying accrue and arise. Accrue and arise the same thing. We cannot, working and not working is also not correct. Accrued and received is also not correct. There's specific word we used and I also highlighted them when I was teaching in this provision. Somebody is writing resident. No. Hardik is saying preceded and succeeded. Succeed. Okay. Accrued and received. Somebody is saying ROR, RNOR. How it is possible, Virendra? Rendering and not rendering? No. So the correct word was, let me show you. It is preceded and succeeded. Where are our notes? Over here. The leave period salary we were talking about, and that was preceded and succeeded. You can see it over here. It was preceded and succeeded. So this is need to be filled over there. It's a very special term, preceded and succeeded. Okay. Back to the question. The correct answer is preceded and succeeded. Sir, मैंने सही बोला. Yes, Hardik, congratulations. You will get Olympic for this, Olympic medal for this. Well done. High. Okay, next is income remitted into India is taxable for ORR. That means ORR means ROR. Okay, same thing. Ordinary resident, or we can call it resident and ordinary resident. So C point is true or false. So the correct answer is of course false because remittance has no impact. It is irrelevant. Ignore it. Completely ignore it. It is for no use. Now, person who concludes order and delivery contract on behalf of the non-resident is a business connection in India. Yeah, that is true. That was not in note. That was a general provision. You can ignore it. You can skip this D point also. Not an issue. It's a business connection example. Okay. So, moving on to some more questions we have. These are also some MCQs, what we are going to discuss and solve. Out of these, some we are going to discuss and solve. Okay. So, if Anirudh, a citizen of India, read it carefully, you have to solve it. I will tell you the answer because you need to take time for these kind of question. If Anirudh, a citizen of India, has stayed in India in the previous year for 181 days. Okay. For 2024-25, he was in India for 181 days. And he's a non-resident in 9 out of 10 years immediately preceding the current previous year. So in 10 preceding year, he was non-resident for 9 years. So this condition is fulfilling. These are additional condition after becoming a resident. and the current previous year. He has stayed in India for 365 days in the all in the 4 preceding immediately the current previous year. And in last proceeding 4 preceding previous year, he was in India for 365 days. And 420 days in all of the 7 preceding years, immediately preceding the current previous year. And for 7 preceding previous year, he was in India for 420 days. So now you need to find out the residential status of Mr. Anirudh for the assessment year 25-26. So take your time and kindly give me the correct answer. As I told you that before solve residential question, always check it out whether the question falls in the special category, that B category. Is it a question of category B 1, 2 or 3 or not? If it is a part of category 1, 2 or 3, then one condition, a special condition will apply, and if it is not, then both conditions should be checked. So first of all, you need to decide whether he is a resident or not. If he is a resident as per your provision, then we will see whether it's a ordinary or not ordinary resident. So Ajay Surya is saying B, Hardik is also saying B. Okay, Miss Maruju is saying B, Sudhir also saying B, Miss Bhavna B, Pallavi is also saying B, Neha also saying B. So the correct answer is, of course, B. How we drive it? Because there is Mr. Anirudh does not fall in the special category of provision. So both conditions should be checked. That is more than equal to 182 days, what is not satisfying. And second one is more than equal to 60 days plus more than equal to 365 days. That condition is fulfilling because he's in India for 181 days. And for 4 preceding year, he was in India for 365 days. So he's a resident now. Now he's a resident, he is fulfilling this condition also and this condition also, less than 730 also. If one of them has been fulfilled, he would be a resident but not ordinary resident. Well done, guys. I guess all students give the correct answer of this question. I did not find any wrong answer in the chat box or query portal, I guess. So congratulations, everyone. It's a good question. Okay, next. Raman, a citizen of India, was employed in Hindustan Lever Limited. Okay. He resigned on 27 September 2024. He received a salary of 40,000 per month. This is simple like leave salary provision. You will solve it yourself. I need to discuss some days calculation question or some logical question. It's a very straightforward question. You will find it out the answer. Okay, next is Mr. Suhan, age 35 years, a non-resident, earned dividend income of 12,50,000 from an Indian company. So he is a non-resident. Clear? Earned dividend income of 12,50,000 from an Indian company, which was declared on 30th September 24, credited directly to his bank account on 5/10/24 in France. So how does it matter? Because it's an Indian company, so this is going to be taxable. Where it is deposited, it does not matter. And 15,000 as interest in saving account from State Bank of India for the previous year, 2024-25. Assuming that he has no other income, what will be the amount of income chargeable to tax? In ends, assessment year 25-26 if he is opting out of the default tax regime. So the correct answer would be D. This is going to be taxable, 12,50,000. And this 15,000 is going to be taxable. So total would be 12,65,000. Now there's a deduction under section 80 TTA for interest on saving account, that is 10,000 that you would come across when you will go for chapter deductions. So that would remaining 12,55,000. So the correct answer would be D. Question number 4 we have already discussed in MCQ. Almost the same question is there. So we need not to discuss it again. You can go through it yourself. Next is Mr. Sumit, an Indian citizen of a member of the crew of an American-bound Indian ship. So that is that signing of an joining certificate case in which we will decide how much time he is outside India, and then we will deduct those days out of the total number of days in India. Clear? International departure Chennai on 25th April 2024. From the following details for previous year, need to find out his residential status of Mr. Sumit for assessment year 24-25. Assuming that his stay in India in the last 4 preceding previous year was 365 days, and last 7 preceding previous year in 2004-25 is 730 days. Okay. Date entering into the continuous discharge certificate in respect of joining the ship Mr. Sumit was 25th April. So we will consider him as outside India from 25th April 24, and this is continuous discharge certificate. That was the joining certificate, and this is discharge signing of certificate on 25th October 24. So from 24th 5th of April till 25th of October, he will be considered as outside India. So out of these 365 days, we will deduct these number of days, including 25th April and 25th October. How many number of days would be there? That need to be deducted. Balance will decide he would be a resident or not. The correct answer, kindly find it out. Then I will let you know what is the correct answer. How many days it would be? Now calculate karte hain. So April 25th will be considered, 25th, 26th, 27th, 28th, 29th, 30th. So April we have 6 days of April. Then May, then June, then July, then August, then September, and then 25th also will be included. That would be 6, 7, 8, 9, and 5 is 4. Then 3, 3, 3, 3, 3, 15, 16, 17, and one is 18. So that would be, I guess, 184 days. Total number of days he is outside India is 184. Correct है ना बच्चों? तुम लोगों ने तो कर ही लिया होगा अब तक. 184 days, correct? So that days he is outside India. So how many days he is in India? One, 8, and 1. He was in India for 181 days in previous year. So let me see how many of you given the correct answer. This is previous year 24-25. This is not a leap year. I guess, okay. So the correct answer would be non-resident. Correct. Question number 5. Because he's in India for less than 182 days. So if it would have been a leap year, suppose in the last year it was have been a question of 23-24, then number of days would be 366, and if we deduct 184, then the number of days left would be 182. In that case, he would have been a resident and ordinary resident. But because in this case, he is not fulfilling the first condition, so that would be a resident, that would be a non-resident. Is 730 days. Okay, correct. Moving on to question number 6. Mr. Square, an Indian citizen, currently reside in Dubai. He came to India in a visit, and his total stay in India during the financial year. Kindly recorrect the answer of question number 5. That would be C. I guess I uploaded the PDF in which the answer might be A, but the correct answer would be C. Clear? So please correct your answer. It should be C. Now, question number 6. Mr. Square, an Indian citizen, currently reside in Dubai. He came to India on a visit and his total stay in India during the financial year 2024-25 was 135 days. So he's an Indian citizen, come to visit in India. He is not liable to pay any tax in Dubai. Following are his details of stay in India in the preceding year. What shall be the registered status for Mr. So and so if his Indian source income is 10 lakhs? That means he does not fall in B third category. He falls in B second category case. So for second category, he needs to fulfill condition number 1, that is 182 days, and he is in India for only 135 days. So the correct answer would be in first question number 6. He comes to India for visit. You can see on a visit and stay in hotel during the financial year 24-25 on these days. So because an Indian citizen, he does fall in the special category of cases, case number 2. And for case number 2, he should be treated as a non-resident because the first condition this is need to be fulfilled. And he does not fulfill that condition, so he would be treated as a non-resident. Dividend from Australian company received in Australia in the year 2023 brought to India would be taxable in whose hand? Of course, we all know. Dividend income from Australian company received in Australia in the year 2023 brought to India during the previous year 24-25 is taxable in the hands of which person? Kindly give me the correct answer. Let me see how many of you can give the correct answer of question number 7. Somebody is saying A, somebody is saying C, somebody is saying A, but the correct answer is, you can see it's D. Why? Because the income belongs to previous year 23. It does not belongs to our previous year 24-25. It's a earlier year income which has been brought into India. So for earlier year income, that cannot be taxed even for resident and ordinary resident. So none of the above is the correct answer. Okay. Question number 8. Mr. Ramesh, a citizen of India, is employed in the Indian embassy. We have discussed the provision of these kind of question also. He is a non-resident for assessment year 25-26. He received salary and allowances in Australia from the government of India for the year ended on 31st March 25 for services rendered by him in Australia. In addition, he was allowed perquisite by the government. Which of the following statement are correct? Salary, allowance and perquisite received outside India are non-taxable in the hands of Mr. Ramesh. This is incorrect because only salary is taxable. All allowances and perquisite received outside India is going to be exempted or non-taxable. Salary, allowance and perquisite received outside India by Mr. Ramesh are taxable in India since they are deemed to accrue or rise. No. Salary received by Mr. Ramesh is taxable in India, but allowance and perks are exempted. Yes, this is the correct option. The correct option is C. Next is Mr. Nishant, a resident, but not ordinary resident for the previous year 23-24 and resident and ordinary resident for the previous year 24-25 have received rent from property in Canada amounting to 1 lakh during the previous year 23-24 in a bank in Canada. During the financial year 24-25, again, this income belongs to the preceding year 23-24. It does not belong to our year. This income just remitted into India in the previous year 24-25. So this is not a rent taxable because it does not belong to the our year. It belongs to the previous year. That is a old year that is not going to be taxable in current year. Now question number 10. Which of the following will qualify as a non-resident? You have to find out of the following information who is going to be treated as a non-resident for previous year 24-25. You have to read the question and then give me the correct answer. So technically there are three separate questions. So the question is regarding for Mr. Joe, Mr. Sanjay and Mr. Chang. So you have to find out of these three persons who or how many was non-resident in India in previous year. Question number 10. So what is the correct answer? Ashutosh is saying D. Okay, anyone else? Mr. Sanjay Bhaskar is saying that means B. Kiran is saying B. Kasak is saying B. Anirudh is saying A. Okay. Pranav is saying B. Bhumika is saying A. Dilip is saying D. Sharmishta is saying B. More answers. Shruti is saying A. Sanjay is saying B. Sondarya is saying A. Kiran is saying Mr. Sanjay, that means B. Pooja is saying B. Ajay Surya is saying A. So let's see who is actually the non-resident one by one. So Mr. J, an Italian designer, came to visit. So he's not a citizen of India, not a person of Indian origin. So he came to visit. That means both condition will be applicable. And he came to India on 3 September 24 and left on 15 December 24. So for September, we will take 28 days. October, we will take 31. November, and for December, these are the days. So total days will be 104. Clear? So he is in India for more than equal to 60 days in previous year, and it says from past 4 years he comes to India for 100 days each year. So technically 400 days in 4 preceding previous year. So he would be a resident. So he could not be a non-resident. Now we will find it out. Mr. Sanjay. Sanjay born and settled in Canada. Okay, visit India each year for 3 months to meet his parents and grandparents born in India in 1946, living in Mumbai. So that means Sanjay is a person of Indian origin. And for person of Indian origin, only condition number 1 will be applicable to make him a resident. His Indian income is 15,20,000. So now the 2 conditions would be applicable for him. First one is he falls in the special category, the third category of B point. So either he would be in India for 182 days or more, or equal to more than 120 days in current year, plus more than equal to 365 days. So he comes to India for 3 months every year. So he cannot satisfy this condition also. So he would be a non-resident. Now we need to see about Mr. Chang, a Korean scientist. Left India to his home country for fixed employment there. He stayed in India for study and research in medicine from this date till 1st July 24. So technically, he left India from 2nd July. So he was okay. Till 1st July. He must left India on 1st July 2024. So 1st July will be considered as in India. Now he is not a citizen, not a person of Indian origin. So if any person who is a citizen of India only having the benefit that if he left India for permanent reason and if he is a citizen of India, this benefit is not available for POIU. Then if he is a citizen, only first condition is applicable, but he is not a citizen, not a POIU. So both conditions should be checked. So he was in India from 1st January 21 till 1st July 24. So in previous year 24-25, he was in India for April, then May, then June, and then first day of July. That was to 92 days he was in India. So the 182-day condition does not fulfill, but the second condition, which is for 60 days, will be applicable, plus more than equal to 365 days. That is applicable. He is fulfilling this condition, 92, and he was in India from last 3 years. So this condition also fulfills, so he would be a resident. So he also cannot be a non-resident. So in that case, the correct answer would be B, because Sanjay is only the person who is technically non-resident out of these 3 persons. I hope it's clear now. So we have solved a lot of questions today, practical question, and I believe that after these questions, the provisions are now more clear and you are more confident to solve these questions in the examination also and for your practice also. If there's any more query, you can ask me, students. So we have completed all the provisions, all the questions over there. If there's any query, you can ask me. This is our last session for residential status, and kindly, for the examination purpose, please work hard. As you can put your hard work in there. Please keep study, make a schedule, complete your course within time, and try to revise those questions. Yes, these question has been uploaded. Kindly change the answer of question number 5 I've told you. I already uploaded the PDF, Hardik. You can check on the portal. Kassak is asking, sir, in case of crew member, joining and leaving date is included while concluding. Yes, the joining date and leaving date is going to be included. Might be it's not showing on portal right now. After 1 or 2 hours, you might be able to see on the portal. I have uploaded that. Don't worry. So all the best for all of you, and I hope we will see each other someday. And for someday, there is always a one day. You have to start 1 day, 2 day, 3 day. Keep studying. All the best for all of you. So, Mr. Bhargav, can